Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew, back again for another podcast, Bills.
Andrew. We are back again, mate, recording another podcast, and we've got a juicy one for our listeners. But how have you been anyway? You keeping well?
Yeah, all is well, Bills. Everything's keeping well. We're opening up, going out. Things are starting to get back to normal.
Look out, back in the offices and away we go, right?
Exactly right.
Melbourne, wake up and here we come. For sure. Andrew, what are we talking to our listeners about today?
Yeah, today we've got a pretty massive topic. So we're going to touch on a bit of a high-level summary and touch on some of the smaller aspects of it. But today we're talking all about debt. We're talking all about using debt to invest, some of the ways that it can be extremely powerful, some of the considerations when you are using it, and making sure that you're utilizing debt in the correct manner.
Yeah, look, it's a really worthwhile strategy that we talk to people about constantly, all of the time. And I guess it's fair to say, and specifically around the property part, and I know that we've spoken about property a little bit recently and stuff, but the truth is not many people would be in a position to be able to invest or purchase such a large asset like property without using debt. But we talk about it in a little bit more detail from an investment aspect and an investment overlay, and talking about why would you do it? Why do you need to do it? What are some of the things that we need to look out for? So yeah, pretty juicy topic. And I reckon that there's going to be some gold in this episode. So yeah.
There's gold in every episode, Billy. Come on.
Well, we don't want to blow our own horn too much. I tend to agree, but we'll just keep that
of grandeur.
We'll just keep that one between you and I. But yeah, let's get into it and away we go.
Yeah. So tell us, Bills. I mean, look, there's a few different types of debt. The one that you obviously spoke about that's specific and kind of relevant to most people is a property and a mortgage. But yeah, what other kinds of debt are there?
I mean, look, there's a lot of debt that we can talk about using to invest, but we'll just drill down on that mortgage because that's probably the one that most people are familiar with. You buy a property to live in, so you're owner-occupier, and you take a mortgage out to help facilitate that purchase. There's a significant difference between that for an owner-occupier versus what we're about to talk about, simply because, I mean, debt is debt from a really simplistic perspective, but the debt on your owner-occupier is not tax deductible. So when we're talking about this from an investment perspective, we're going to take the stance that the debt that we've got is for investment purposes, which the interest then becomes tax deductible. So from a cash flow perspective, being able to claim the tax deductibility back can make a significant difference to how that investment is, I wouldn't say performing, but from a cash flow perspective, it'll allow you to be able to hold that investment where ordinarily you may not have had that chance. And we'll delve into that a little bit further when we get into negative gearing and what that constitutes. But from a really simplistic perspective, you've got a mortgage, you've got some equity in your property. You could potentially access that equity and use that money to invest in an income generating asset. And that's probably it in its simplest form when we're talking about a mortgage related debt product.
Yep. So it's not just as simple as you buy an investment property. It can also be equity in your owner-occupied family home. You pull the equity out and utilize that to invest in whatever the investment asset is. So there's really a couple of ways that we can have mortgage debt that's for an investment purpose. One of them is obviously the simple one, purchase an investment property. The other is utilize the equity in an owner-occupied property to invest.
Yep. And that seems to be a really common way of how, I guess, people that are in their first home, they haven't obviously paid it off, but they'll draw equity out. And that's usually the mechanism to be able to then use that as a deposit to be able to get into their first investment property. Really common strategy that we see all the time. Essentially, you're taking money out your existing property in order to get your deposit and your stamp duty up, and then you're borrowing the rest of the money against the property that you are purchasing. So really common strategy. If it is for investment purposes, all of that becomes tax deductible. But using the same strategy as well too, releasing equity to invest, it still becomes tax deductible if it's for income generating purposes. So it doesn't necessarily just need to be in a property as well. It could be in a share portfolio, it could be in a managed fund portfolio, it could be in a range of different things. It's just the requirement that the taxation department uses is it for income generating purposes? And if it is, then the interest on the loan is tax deductible.
And look, there's other types of debt that you can utilize for investment purposes as well. So for instance, a margin loan. A margin loan is essentially a loan that you're utilizing as the equity on the loan, and the secured asset is now not a property. It's usually comprised of shares and managed funds. So what that actually means is you've got a portfolio of shares and managed funds. You utilize that portfolio as security, and you utilize essentially the equity in that portfolio in order to be able to take additional debt against that and invest that in most cases, more shares and managed funds. Obviously a riskier strategy, just because the margin loan a margin loan will operate a little bit differently to how a home loan does. In a home loan, you make your mortgage repayments and that's it. The bank doesn't care what happens to the value of the property as long as you make your mortgage repayments. In a margin loan, and this is probably a topic in itself to really unpack and look at what a margin loan ultimately entails. But in a margin loan, there are things called margin calls, where if the value of the shares in the managed funds drops below a certain value, the bank asks you to either liquidate a part of your portfolio or add additional funds into that portfolio. So a margin loan will usually have a little bit more of a higher interest rate. It'll also incorporate things like margin calls in there. So a bit of a more complex and riskier strategy can be beneficial for some clients depending on the situation, but that's another instrument that you can utilize, or another debt instrument that you can utilize for investment purposes.
Andrew, I've just added that one to the future episode list because there's definitely an episode in there that we can unpack and talk about, because a margin loan is quite, I wouldn't necessarily say a complex product, but there's a fair few moving parts to it that probably needs a little bit more time, and I reckon that could be really beneficial to our listeners. So I've added that one to the list for future episodes. Let's talk about the benefits of using debt. And we'll go back maybe to the property aspect, because the truth is, I don't think a lot of people would be in a position to purchase a property or having 100% of the funds available, just because by the time you save up and stuff like that. So let's talk about some of the benefits associated with what opportunities it gives us by being able to borrow.
Yeah. So look, as you said, first and foremost, debt provides most people with the ability to purchase assets that you otherwise wouldn't have been able to purchase. Property is obviously the example that's kind of rings true to most people. If you're purchasing an investment property, or if you're taking equity out or using property for an investment purpose, most people wouldn't have the funds available to purchase that 100% with their own money. So debt gives you the ability, quite simply, to purchase assets that you otherwise wouldn't have been able to.
Yep. Easy said, easy to understand. I guess the property context is the easiest one to think of in that perspective. Not only talking about using debt to get into a property or a bigger asset, from a cash flow perspective and leaning into deductible debt, so using debt in order to invest to generate income, where the interest becomes tax deductible. Geez, that's a mouthful. By looking at the cash flow requirements of servicing the debt, by making the interest tax deductible, obviously helps out from a cash flow perspective. And it's been a really common strategy that we've seen deployed over the decades, where you hear the stories where someone will go and talk to their accountant and they complain that, hey, we're paying too much tax. So one of the pieces of, I'll call it advice, but not advice, because they're not really meant to advise on this stuff, or they're not meant to advise on it, is go and get yourself an investment property so you can have some debt that becomes deductible, which should fix some of the issues that you're complaining about, which is paying too much tax. So essentially what this is creating an environment where a client purchases a negatively geared property, which means it's costing more money to maintain the property than the property is actually generating for the investor. And that loss there from a cash flow perspective is then offset against somebody's income in the year that they're doing their tax return. So they're taking a short-term hit from a cash flow perspective, but the idea is over the time frame, the capital growth of the property will continue to grow, and the benefit that you'll get will be at some future date when you eventually sell the property for a much larger gain than what you bought it for. So it's kind of a bit of financial engineering around using the cash flow around not only the debt, but also the deficit that the property is generating against the cost that it takes to hold the property.
I mean, I definitely agree. And it's definitely something that can be utilized for some great gains, and negatively gearing a property is a strategy that people have been using for many years. The only thing that I'd throw into that mix and really like to unpack with clients is why. Why are you purchasing a negatively geared property? What's the overall strategy? What are you trying to achieve? Because the amount of times that I've sat in front of a client and they say, yep, I want to reduce my tax, so we want to purchase a negatively geared property, and that's going to help us achieve our wealth creation. But when you delve down into what does a negatively geared property mean, it means that you're losing money, and so you're getting a tax deduction from it. Sometimes people can focus too much on the tax element. Don't focus on losing money so that you can get a tax deduction. And granted, this is the golden asset that doesn't always doesn't present itself. But if you can have a positively geared property and still have capital appreciation, yes, you're going to pay some money in tax, but you'd rather make money and pay tax than lose money and get a tax deduction. So making sure that this fits into the overall picture, making sure that this fits into your overarching strategy, and deciding on what are you actually trying to achieve off the back of purchasing this asset is ultimately the most important thing. Not just, okay, I've heard that negatively gearing a property is good for tax, I'm just going to go down that route.
Andrew, you know what? I mean, it's never really made sense in my mind as well, because you don't enter into any investment with the intention of losing money. It doesn't make any sense, but it's always been one of those things. And I was smiling before when you said, why are people doing it? And I guess traditionally for a long time, it's just been accumulation and get your name on a title, and that's been the name of the game. But obviously that's changed, and you've got to be a lot more strategic about it now. But yeah, that's a really interesting point. And I think you explained that really nicely. One of the other considerations too is with any investment where you are taking on debt, regardless of the deductibility status, you need to look at it from a perspective of what risk are you assuming as well. And you'd mentioned before that being able to borrow can give you the ability to get into a bigger asset that you wouldn't necessarily have had exposure to before. It can magnify your gains. And we've seen that done really, really well, I guess in Melbourne in particular, which is where we're from, and using the property market as the asset class, that's worked really, really well. The other thing and the other consideration from a risk perspective is if it goes the other way, it can also magnify your losses as well. Probably a bigger consideration for a non-property related investment. Take a share portfolio for argument's sake, where the share price is listed every second of the day during trading hours anyway. You can see what your asset's doing at that particular point in time. So it's a lot easier to see where your asset position is against the debt that you've committed to that. Whereas with something like, say, property, you can't get a real price unless you actually test the market and put it on the market. Plus, it takes a lot longer to transact on a property than it does on a share portfolio. So it's a different asset class. But just one of the things that we can't understate is the risk associated with, from a loss perspective, taking on debt does actually magnify your losses as well and can be quite detrimental. We'll talk about some of the strategies that we deploy in order to manage that risk. But yeah, we can't understate that enough, that there is also the potential that if things go the other way, that it's going to end.
Yeah. And I guess the example of that is if you're utilizing debt, your risk is not just in the amount of money that you invest. So let's say you decide to purchase a share for $100. Your risk is that you lose that $100 and that dwindles down to zero. That's the absolute worst case scenario. But if you purchase the share for $100 and then you also take some debt associated with that $100, your risk is not only on $100 that you initially invested, your risk is on your debt position. So if you took $50 as a margin loan, for example, you're also risking the debt and your initial investment and the interest that you've accumulated over that period of time. So not only is your investment risk just the amount of money that you've put in, it's also the debt associated with that investment as well.
Yep. No, well said. Well said. Debt recycling, Andrew, is something that we speak to clients about all of the time. A little bit more of a technical strategy, but how does that fit into what we're talking about?
Yeah. So again, utilizing the power of debt and utilizing some of the benefits of debt really to invest. And that's, in essence, what you're doing is drawing equity out of an owner-occupied property, utilizing that to invest in an income-generating asset. The income from that asset is used to pay down your non-deductible debt. So already the debt that you've already had previously, and you're converting the equity that you're drawing out of your owner-occupied property from non-deductible to deductible. Now, that's a massive mouthful. We've got a full podcast on it, so a full 30 minutes rather than 30 seconds.
Yep.
But basically what you're doing is, through the power of an income-generating asset and equity in your existing owner-occupied property, you're converting your debt from non-deductible to tax-deductible. So really powerful strategy. Again, need to assess your cash flow position, need to assess your asset position and your overarching strategy. So not something to be entered into unless you're really receiving advice around what it is that you're doing, why you're doing it, and how it's beneficial, but can be a very, very powerful tool to accelerate your debt repayments, pay down your debt faster, and at the same time, build a portfolio that you may or may not otherwise have had.
Yeah. And that really there, and you did mention it in the podcast and stuff, but that there is probably a really good example of the cash flow, using the financial engineering to determine the cash flow to help support the strategy. So that's a really good example of converting, let's call it unproductive debt to productive debt, which means you can claim the tax deduction on it. And when you do go down that path, it makes the strategy, I guess, viable from that perspective in the right economic environment. But yeah, that's a really good example. Debt recycling is a really good example of how the non-deductible versus the deductible debt changes the viability of an investment. 100%. Yeah. Yep. Some of the risks that we spoke about, Andrew, obviously magnifying losses is something that we spoke to our listeners about and can't be understated. You're risking more than your initial investment. You touched on that before as well too. You spoke a little bit about the interest eating into the profits and the cash flow as well. I guess that's probably a bigger consideration as the debt gets higher.
Yeah, I mean, interest rates are not going to stay at the same level that they have been in recent years. And so as interest rates rise, and primarily when your debt is on a variable interest rate rather than a fixed interest rate, but as the interest rates rise, it's going to have a larger and larger impact to your cash flow position if you're funding the interest from your cash flow, but also from the profits of the investment. So if you're investing in an asset, utilizing debt to invest, as your expenses increase to continue to maintain that facility, that's going to eat into the profits and the viability of that investment as well.
Yeah, which is a really big consideration because we're entering into a market or an environment where there's a lot of talk about interest rates rising. We'll see what that looks like. But yeah, that's obviously a big consideration because every time interest rates do increase, it will eat into the performance of a strategy where debt is deployed.
If you're assessing, it doesn't make sense to assess an investment just based off today's interest rates. So at the end of the day, if you're an investor, if you're utilizing debt to invest, you need to make sure that you're accounting for the fact that interest rates may and probably will continue to increase in the future. And so you need to be able to support that from your cash flow. You don't want to be in a position where you're forced to sell an asset at a particular point in time because it doesn't become, or because it becomes unaffordable. And so really you want to be selling an asset when it meets your personal circumstances, your strategy and your goals, not because you're forced to sell that asset.
Yeah, well, that's a really good point, Andrew. We should lean into that. You were talking about the cash flow requirements in order to support a particular strategy. And obviously taking on debt comes with the obligation to not only service the debt, but make the repayments, unless it's just interest only, but we might just park that one for a sec. Making sure that you've got the right things in place because the repayments are going to need to get made regardless of the underlying performance of whatever the asset is that you've invested in. Once again, interest rates will lead into that depending on the performance, depending on the cash flow. If we are talking about something like a share portfolio and the share price goes down, that could have an impact, or the underlying businesses don't perform as well as they were meant to. Maybe the dividend that you were expecting is less or different to what you were anticipating. That will cause some issues down the track as well too. So needing to make sure that from a personal perspective, you're in a position to be able to service this and have some contingencies in mind in case it doesn't go the way that you want to. A recent example from a personal aspect, tenant moved out of my investment property and because of some of the rolling lockdowns and stuff, it was difficult to get inspections done. So the time frame between tenancies was longer than what any landlord would have preferred, but we managed to get there in the end. But that was a gap in my cash flow that I needed to account for using some other mechanism. And in saying that, I still needed to service the debt associated with that property.
Yeah. So you can't assume that if you're purchasing an asset that everything's going to continue, everything's going to be hunky-dory and there's not going to be any hiccups along the way. You need to make sure that there's some stop losses there. You need to make sure that there's some ability to change and adapt the strategy, even though that may not be the initial assumption when you're first purchasing into that asset or purchasing into that debt, really.
Yep. And I guess one of the ways to think about this from a risk mitigation perspective, and we go through this conversation all the time, is the level of gearing or the ratio, the loan to value ratio that we gear at. Andrew, you want to run us through what we talk to clients about with that?
Yeah. I mean, making sure that your debt is going to be serviceable as things change or as circumstances change is critically important. And one of the most important factors within that, or one of the big determinants within that, is not debt to value ratio is one of the important factors, but also debt to income ratio. So you want to make sure that your debt is within a certain level of your income to make sure that it's going to be serviceable if the income from the asset isn't supporting servicing that debt. But a loan to value ratio, which you were talking about, is quite simply the percentage that the loan represents of the overall property. So if you're purchasing, an easiest example is an investment property, most people think of, 20% is kind of the limit for most people if you want to avoid mortgage insurance. So you need to have a 20% deposit so that the value of the property is, or that the debt associated with the property is only 80% of the value of the debt. There isn't a one size fits all, and there isn't a rule of thumb that you want to stick to when it comes to loan to value ratio, just because depending on the type of asset that you're investing in, depending on your circumstances, is ultimately going to determine what type of debt or loan to value ratio that you will be able to service, and that's going to be doable. For instance, if you're investing in a margin loan, 80% is a pretty risky number in terms of loan to value ratio, whereas an investment property, that seems to really be the norm these days. And we've seen many times that it gets pushed even further than that with 10% deposits, and in some instances even less. But making sure that doable from your circumstances and making sure that you've got some certainty in relation to income is ultimately what's going to help and support a risk mitigation strategy if things don't work out as planned.
Yep. So things around that, certainty in income. So obviously, I guess it sounds obvious from our perspective, but you don't borrow money unless you're confident that you can pay it back. Looking at things like what cash reserves have you got available in case there is a gap in your income for whatever reason, or in case, you have unexpected expenses come up, making sure that you're borrowing as best as you possibly can, but borrowing at a competitive rate, understanding the instrument that you're using to borrow money with. You were talking about a margin loan before. The way that a margin loan behaves versus the way that using debt out of a property is treated is completely different. So understanding what it is that you're actually using as your leverage vehicle, understand the asset that you're actually purchasing into and how they behave and how they operate. And I guess more so closer to home from a financial planning perspective, make sure you've got your insurances in place in case anything happens and something goes untoward in your personal life. They're probably the key aspects around the risk mitigation part that we talk to clients about from that perspective. Andrew, what about variable versus fixed interest rates on the debt that we're assuming?
Most people think of variable versus fixed interest rates, and it's not incorrect way to think, but most people think of it as, if you believe that interest rates are going to go up, then you go on a fixed interest rate because you're going to lock in the current rate. If you believe that interest rates are going to go down, then you prefer a variable rate with the expectation that your interest rates will decrease. And that's perfectly viable way to look at fixed versus variable interest rates. However, another way to look at it and another consideration is, even irrespective of where you see interest rates moving, sometimes it is appropriate to look at a fixed interest rate regardless, just because you've got certainty around, and very few loans will give you a fixed rate forever most of the time, unless it's a shorter term loan in nature. But most, if you're talking about home loans, we'll look at 2-3 years in terms of fixed interest rates. but it gives you the certainty that, okay, I know that my cash flow requirement for the next X amount of years, this is exactly what I'm going to need. And I'm not going to be caught in a position where if interest rates move, I'm going to be negatively impacted from a cash flow perspective. So a lot of the times fixed interest rates can be used as a risk mitigation strategy so that you can sleep easy at night knowing that, okay, I know exactly what my repayments are going to be and nothing is going to change over a period of time.
Yeah, and I guess that gives people a lot of comfort. I mean, we have that conversation with people all of the time that that's one aspect of the strategy that you can just take off the table and remove. We call it the sleep test, but you don't have to worry about interest rates rising if you're in a fixed rate period. In the short term, at least. In saying that, you might have a 2 or a 3 year fixed term. If interest rates have moved over that period, yeah, great. You're not going to feel over that period of time. But the consideration would be, okay, when I get out of the fixed rate period, what's the interest rate going to be? So especially if the strategy is longer term in nature, which generally from an investment perspective, it should be. But yeah, absolutely right. One of the ways to mitigate the strategy, I'd say in the shorter term, is to look at the fixed interest rate, which is especially relevant in this environment because we are entering into a time where interest rates are starting to increase.
And in addition to that, I mean, you're talking about if you're looking at a fixed interest rate, making sure that if interest rates rise after that fixed period expires, there's the cash flow there in order to support it. Exactly the same thing when you're talking about interest-only loans. We've seen instances where people have entered into interest-only loans because it's viable from a cash flow perspective. You're not needing to make principal repayments. But what happens once that interest-only period expires? Again, you don't want to be forced in a position where you have to liquidate an asset because it doesn't meet your cash flow requirements. So making sure that even if you are looking at an interest-only loan because XYZ reason, even you want to make sure that once that interest-only period expires, you can still make principal and interest repayments and you are still going to be able to facilitate paying down that loan in the future.
Yeah, no, well said and well summarized, Andrew. I reckon that probably wraps it up for this episode on debt and leveraging and all the fun stuff associated with that.
Yeah, and I reckon we've gotten at least one extra episode onto the list, onto the ever-growing list of things to talk about off the back of it as well.
No, absolutely. Andrew, like always, thank you for your time. And to our listeners, thank you for your attention. Hopefully you got some value out of today's episode. And we look forward to catching you on the next one.
Yeah, thanks very much, Billy. Thanks again to our listeners. Again, details are all in the show notes. If you want to reach out, if you've got any questions associated, more than happy to chat through with that. Thanks very much, and we'll catch you on the next podcast.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorised representatives and credit representatives of AMP Financial Planning.